Good morning. Welcome to the Dakota Housing Network with Joe Sheehan and
Dave Flohr.
And we're, of course, we are very excited today because we have on the radio today with us, not yet, he's in the next segment, but Bill Bodner from the Mortgage Market Guide, the Oracle, as we tee him up. And we can't wait to get him on the air here and tell you what our interest rate's going to do for 2018, what's the economy going to do, and we will. What's so exciting about having Bill on is back in 2011, he came on the show when it was Mortgage Talk 101 and predicted that interest rates would stay below 5% till 2020.
Yep, and we are 2018. The last I checked,
we're heading into the home stretch, and here we go. Bill Bodner is
conventional rate is what,
4.25, 4.125, depending on the points that we get from the Fannie Freddie.
So we got a long ways to go before we get to 5%.
And now as I'm sure Bill will talk about when he gets on the show in the first segment, we do have interest rate pressure. We have lots of pressure on interest rates right now. Yeah. We have number one, we have the Fed getting out.
They're stopping. They're not buying securities anymore. They're raising their overnight rates. So they're shrinking their balance sheet, as they like to say, and raising their overnight rate, which doesn't have a huge effect on mortgage rates, but that's putting, as you said, that interest rate pressure for rates to go up. Because
the biggest buyer of mortgage bonds, so just so everybody understands this, when the Fed's buying mortgage bonds, they're helping interest rates go lower or stay stable because the Fed buying mortgage bonds creates a market for them that keeps everything stable.
Yep.
And so that's a big deal. The Fed has been a big deal. If you ask, how is it that interest rates have stayed so low while the market's gone up? Markets had 15% gains and all those kind of things. Why have interest rates stayed so low? It's because the Fed has created the market for lower interest rates.
They were the market.
They are the market right
for a
now.
Long time.
So them getting out of it is probably the number one big pressure on it. So number two is the China.
Yep.
And China is now the problem is this is a perennial threat. China every year says we may stop buying U.S. debt.
Not going to buy it, and they typically buy Treasury bonds.
Yep. And that has a sympathy effect, and it does control the market for. They're another market maker.
Yes.
Between them and the Fed, you probably get. A majority of the market for that's affecting the debt. So
Jim's.
I think we got him on the phone.
Do we have Bill Bodner on the phone already?
Hey, Joe. Good morning.
Hello. Try it again. Hello.
Hi. Good morning.
Hey, Bill. How you doing? We were just as our producer was bringing you online. We were bringing in we were talking about the current pressure on interest rates. Number one. Yep. The Fed saying that they're going to get out of buying, unwind their balance sheet, and we've talked about how they've been the major market maker and how actually they are the reason why interest rates have stayed so low during tremendous market growth. So, and number two, China is threatening, but China's been threatening for a long time. But then finally, if the Fed and the Chinese get out of the debt buying business or the U.S. debt buying business, then it returns to more of a normal response to what the market's doing, and the market's been hot. And so we've been saying that you predicted interest rates would stay below 5% until 2020, and you've got a marvelous run. Here's the test. We're in the last 2 years, and there is tremendous pressure on interest rates. Depending on what happens with the Chinese and depending on what happens with continued market growth. And so that is exactly where we were going to hand the baton off to you, the Oracle, Bill Bodner.
Let's introduce the guy first, though. We got to have our fun with him.
There we go. Go ahead.
Right? Hi, Bill. This is Dave.
Doug, how you doing?
How you doing, man? Good. But yes, you are the Oracle, at least on the Dakota Housing Network. I don't know about anywhere else. Would you say you are or
one and
not?
only up there. That's fantastic.
Just here,
By the way,
okay.
real
All
quick,
right.
congratulations on Benchmark. That's wonderful.
Hey, thank you, Bill.
Yeah. But anyway, and this, Joe, this is another segment of two dumb guys
asking questions
of a smart guy.
That's for sure.
Yeah, we know it on this case. So we love it when we have these
My goodness,
episodes.
there's so much to talk about.
Yeah.
How long are we
Yeah.
going to go for, guys?
Yeah, we got 45 minutes about.
Yep.
So we got a couple breaks in here, but yeah. So ready, set. The baton is to you. Interest rates were going to be below 5% till 2020. We're entering into 2018 with a tremendous amount of pressure. We set the stage for why that is. And ready, set. Let the Bodnerese begin.
Love it.
Okay, so
What's going to happen with all this pressure on interest rates?
yeah. So you made that prediction. I know you stand by it. Below 5% till 2020. What do you think would cause that to not happen today?
Well, first of all, guys, thanks and good morning. When I look at 2017 and what we've been saying for a long time, the bond market has had major tailwinds. One of them obviously was the Fed, right? Low interest rates. But there were other things that were happening that were allowing rates to stay at such ridiculous levels. One being inflation, right? Really, consumer inflation by a lot of metrics has been super cool. I mean, it's funny how the Fed used words like transitory to describe it. They're persistently low, and transitory, right, by definition, is something not permanent, but if it's there for a decade, it starts to feel permanent. So low inflation was a problem. The lack of wage growth, which we can talk to because that actually relates to housing, has always been a problem. That's the real, that's another thing that has, I think they work hand in hand, right? So if wages start to go up, you get what's called wage-based inflation. That starts to get in there because now more people have money in their pockets. They can buy goods. It puts price pressure. We haven't seen anything close to that up until now. And then the big tailwind was the government. I mean, there was a joke what was happening in Washington, D.C., up until recently with the tax reform, right? Washington was a disaster. It was, it's all about collusion and political garbage. Couldn't get anything done. And so with Congress getting nothing done, it actually allowed, good news is bad news for rates. But lo and behold, all of a sudden these things that were once tailwinds are now becoming a headwind. And so now inflation's starting to perk up. The government got the tax reform done. Now you're seeing all this incredible, the stream of ongoing positive news coming into the market. There's nowhere for rates to go but up. Every time you look, consumer sentiment is at the highest in this century, right? It hasn't been better in years. And so these are things that are going to be tailwinds to rates. And so the Fed, obviously, I know you mentioned it's playing a huge role in this. And it really remains to be seen how we come out of this. Because I'm a simple guy. I look at this. If you're a buyer, right, you're buying, you're keeping rates stable, and now you're saying we're going to unwind this, well, you know what? Don't worry. We have the tools to do so without disruption. How can you say that when it's never been done on planet Earth, right? So it'll be really.
And how much money are we talking about, Bill? What do they got on their balance sheet now? It's like $5 trillion or something, isn't it? $2.5 trillion. It's trillions. I can't remember the last number.
You know what? It's like $4 trillion, and split up between mortgage-backed securities and treasuries. And there's a lot of runoff. Listen, they're supposed to do this thoughtful and. I just don't see as the caps come in, right? Because they're doing every quarter, they have caps. So as the money rolls off these bonds, they're going to have a limit to what they can purchase. Right now, it's about $10 billion, and then anything over $10 billion they can buy. But it'll eventually get to $50 billion. So they have to have at least $50 billion in runoff before they can even go to market. So it's going to be interesting. I think that if you're on this call, you're thinking about a house, you're thinking about refinancing. The best time was 2 weeks ago. Second best time might be right now.
Well, good news for we'll come back with that with when is too late for you as a buyer or homeowner to think about low interest rates with Bill Bodner from the Mortgage Market Guide, the Oracle, here on the Dakota Housing Network after the break.
Right now, 23.
The Red River Farm Network. Ag News is here on SuperTalk 1270.
Hey, welcome back to the Dakota Housing Network with Joe Sheehan, Dave Flohr.
Leonard Skinner today. They announced the farewell tour.
Farewell tour.
They're getting old. All these old bands. Elton John, Leonard Skinner, everybody else.
Finally, some of them are finally hanging up. But, welcome back to an edition of Two Dumb Guys Asking Smart Guy Questions. As we've got Bill Bodner with the Mortgage Market Guide here, and we just ended the last segment talking about how there's all this pressure on interest rates to finally go up. It hasn't been there for a long time. And Bill, you were saying if you were going to take advantage of the lowest interest rates ever, you might be 2 weeks too late.
Oh, well, I don't think. Listen, there's when you look at refinance activity, I think that for those folks looking to refinance, we might have, we might be looking in the rearview mirror at what were the better rates for some time. There's just too many good things happening. For the housing folks, though, for the folks that are buying a home and the folks on this call that are real estate professionals, it's an unbelievable environment because no one buys a home based on rate. It's not like you can go for a shelter and rate ticked up, I can't do something. You buy a home because of optimism. You buy homes because your wages are rising. You're buying a home because you feel comfortable that you're not losing your job. And so I think that this is an unbelievable time for a home purchase. And at the same time, when I think of inflation just starting to manifest, housing is a great hedge on inflation. So even for the folks out there that, in the mortgage side that are talking to, why should I be doing it? Those are things that people don't even think about. And so, while rates have ticked up, let's be frank, what are we coming off of? I mean, the yield on a 10-year note is still, 260. I mean, does it belong there? Probably not. And that's why, I think the market, as you said before, is starting to kind of normalize. I mean, I think we have to get out of this super accommodative, punch bowl that we've been in the last 10 years or so with the Fed to something that's more normal, and it's going to be just feel a little bit different. I mean, the funny thing, the millennials are seeing yields. Oh my God, they ticked up. But we did that forecast call with Elliot Eisenberg a couple weeks ago, and back in '81, the 10-year note yield was 15 and change. So when you look at it from a historical perspective, still unbelievable rate opportunity.
And it really, if anybody's questions, you're sitting there with a customer in your office and they start questioning, well, rates are going up, but you throw them out those historical numbers and no, it's not really. And like you said, most people aren't buying a home based on their rate.
It's really affordable.
They'll take what's the lowest rate I can get today, I think is more important
That's
than
right.
what it was 2 weeks ago.
Right. So talk about, you were saying that the Fed is like, we're going to control this. We're going to unwind this $4 trillion on our balance sheet, and we're going to control this impact interest rates. Give us more insight on the entire Fed picture. So we know interest rates are likely to tick up. There's finally pressure on interest rates for people who are going to refinance, maybe not. If you're just looking at getting a lower rate, your time may have passed. But for people who are in the home buying market, things are really going to be good, and especially because the economy is strong, things are really going to be good for them.
But how about this? I mean, how about the fact that so many folks listening, right, if they have any money at all within a 401k or a brokerage account, they're like 30 to 40% wealthier just in the last, 12 to 14 months. I mean, the stock market has been up like 40-something%. I mean, you could throw a dart on the board and be up significantly. So, I mean, that's pretty impressive to, collateral to go out and buy homes. So I think there's just a lot of good things happening there. So, as it relates to the Fed,
and guess what you can use those 401ks for?
That's the one that can really change things for us.
And you know what you can use the 401ks for? You can use the 401ks for your own down payment assistance program to help you put a down payment on a house. So the increase in the 401k growth is absolutely in line with people's ability to engage home ownership if they want to. But so talk about the Fed and what's the Fed's impact going to be in the next couple of years here?
First off, I think that probably is the part that, if you were to say what are the one thing that kind of keeps me up a little bit, that would be the one, the Fed, because you just don't know what they can do. I think right now, there were forecasts for 3 rate hikes. We've been talking a long time, David and Joe, and I don't know that they're going to do that much. I think they have to wait. They have to see inflation, perk up a bit before they pull the trigger, and they have to wait to see what other policies come out of Washington, and they also have to see when the rubber meets the road on these tax cuts and reform. I mean, let's be honest. The other thing great for housing is starting on the very next payroll. Everybody on this call is going to have more money taxed at a lower rate. That's a pretty good thing. That hasn't even hit yet. And so, what I worry about is if the Fed overcooks it, right, and they can really kill the golden goose. But here's the ironic thing. So let's just say the Fed goes and hikes rates. I think what will actually happen there, because why does the Fed hike rates? And they can't hike mortgage rates. They can only hike a short-term, overnight lending rate. And so what would happen is they're doing that to stop inflation, right? That's why I worry. If there's no inflation, why are you really hiking aggressively? And so in that, when they do that, you actually preserve the value of long-term bonds. And so I think what might happen is it can actually hurt the stock market, which in turn might benefit the bond market even better, the long end of the bond market. So mortgage might actually perform better if the Fed got in there and hiked a little bit, because I do think it would take some of the shine out of the stock market, if that makes any sense.
Absolutely. Anything that wrecks the confidence in the investors is going to help us in the rate market in terms of low rates. But in terms of that, so what's your over under on the Fed doing 3 rate hikes?
I think it's under. I think it's under. Yeah. But the wild card is, here's the other thing that I just, I want to say the under because I hope they don't do it. But I also think at the same time that the tax cut, this tax reform, whatever you want to call it, I think it's been understated. I really, I laugh when all the economists are in one camp. It's not going to do anything. It's not going to do anything. Even my friend Elliot Eisberg said it's not going to do anything. I don't know about that. I mean, when everybody's on one side of the equation, you almost have to bet the other way, and I think it's being grossly understated. We watch this stuff constantly, and you're seeing money getting thrown out there, these one-time bonuses, raises of the 401k, earnings going up. I mean, some very material. And I'm like, how can you say it's not going to happen? I mean, these are things that are happening that I don't think anybody put in their model, right, when they're saying where the growth is going to come from. And what's really exciting about this isn't just a one and done. I mean, that corporate stuff is going to start coming in more and more and more. It's going to be unbelievable. And, think about it. As more companies come in to do business, because now you're watching President Trump in Davos right now. He's out there trying to say, hey, America's open for business. And so making us very competitive on a corporate landscape, that's going to mean that people are going to be fighting for jobs. And, how do you get people to go your way? You got to pay them more. And so, I think if we start to see acceleration, you're going to see the Fed up the ante. And then what I worry about then is if they overcook what would be hikes. So it'll be an interesting year. I do think that the tax reform is understated. I think it's going to be much better than people are thinking about. And I think we're going to see, finally, three-handle growth for the first time in a long while over a, year-on-year basis. So really the only threat to the economy right now potential Fed tax hike or Fed interest rate hike? I really do. I mean, there's no threat of a recession. It's not even it's nowhere near anything. The economy, the confidence, it's unbelievable. In fact, I would argue that it's accelerating. And that's global, correct? That confidence is global. Bull market and rising, growing economy. We're actually accelerating. It's really a special time that we're in right now. And that's why you're seeing the stock market go up. It isn't frothy. I think I'm watching a lot of people a lot smarter than me, and they talk about this, this corporate stuff coming back, and they think the stock market has probably another 15 to 20% to go. Just if you just take out, just how they run the numbers. I mean, just the amount of money coming into this country. It's really remarkable. Like they opened up a dam and boom, it's flying in, and you can see it going everywhere. On these projects, expansions, and it's really something. Unfortunately, it's not being told everywhere. And for those that are in the markets and actually watching this stuff, it's pretty easy. I mean, the stock market's telling you when it goes from 17,000 to 26 and change in the course of 14 months, something very special is going on, right? So we've talked a long time about how there's about $2.5 trillion in corporate capital on the sidelines. You're saying that's coming back into play, and that's part of the growth. Oh God, yeah, and it's coming over. And the thing is, it isn't in one wave. It seems it's like the gift that keeps giving, right? Like Cousin Eddie, it just keeps on giving. It's like every other day, some of the companies saying they're bringing all this capital. Look at what Apple did. And he says they're going to invest $350 billion over 5 years, and they're going to hire 50,000 people. I mean, just sick, crazy numbers. I mean, that's like hiring a state of workers, right? It's really remarkable, and that money is only coming now. That is only the repatriation. What about now? Just the friendly regulatory environment, and now competitive tax. I mean, we went from 35 to 21, right? 22, wherever we landed on corporate. We're now right in the middle of the developed countries' tax. So now it isn't like, hey, if I want to go anywhere, now I just want to go where it's friendly. And boy, I tell you, if nothing else, I mean, our environment has become very friendly to open up shop. So wait until we start seeing those stories evolve, where somebody actually leaves, Germany or somewhere else to put a plant in the United States. It'll be you're going to see those stories too, where people, move their headquarters back.
Well, when we come back, when we get after break, one of the things I'd really like to have you now talk about for our listeners in the next segment is the tax reform and its impact on housing. And what people are saying, what the economists are saying. Already, you just closed our segment by saying the tax reform is going to impact housing by creating more money, a stronger economy, better confidence, and that's what you're saying is going to drive home buying in the future is optimism of the home buyer. I mean, so what a great way to close this segment as we move into the next segment. But if you could talk about how the tax reform is going to impact the home buyer in the next segment, Bill, we would love to hear what you got to say on that as we roll out into the break with Leonard Skinner on the Dakota Housing Network. Two dumb guys talking to a smart guy. Back with Bill Bodner after the break.
Right now, 23.
On Twitter, Facebook, online, and YouTube. SuperTalk1270.com.
Leonard Skinner. Our name, two dumb guys talking to a smart guy. Dave Flohr, Joe Sheehan on Dakota Housing Network with Jim Walsh on the board. And our special guest, the Oracle of Dakota Housing Network, Mr. Bill Bodner.
Yep. Yeah. Well, and you know what? And we should add to his resume for our listeners.
Okay.
Drummer, right? Of an 80s cover band.
Oh, yes. Yeah. And a golfer.
That's right.
Professional golfer. God. Yeah. I mean, he's the Oracle. It's just.
There it is.
Yeah.
So coming back into it, we were talking about the impact of tax reform, a positive on the economy, improving optimism, which you think is going to be a driving force for one of the best purchase environments for people to buy homes. Let's talk about the individual person with the higher standard deductions and stuff like that. We're hearing a lot of noise just right now in the market about, this is going to impact tax deductibility and home equities and all that stuff. What does tax reform mean for the average borrower in the housing market?
Sure. A lot of thoughts there. First off, housing obviously is regional, right? It isn't national. It's all over the place. And I think with tax reform, it has become even more so. When I look at states like where I live, goodness, I'm in New Jersey. I'm being punished significantly. I don't know what your taxes are up there.
Thanks for taking the pain. Taking the pain.
Imagine they probably. What's that?
Thanks for taking our pain.
Take one for the team.
Yeah. You guys are definitely taking one for the team out in New Jersey.
It's really bad. And so when I look at places like New Jersey, New York, California, there's absolutely going to be some pressures, especially on the high end, because of obviously the SALT, right, state and local income tax deduction. That's one hit. And then obviously on the mortgage interest, that as well. And so as you get into those higher, homes, higher priced homes, that's going to be some pressure. But then you look at other places, probably like your backyard, Florida, Texas. I mean, they have unbelievable tailwinds of an influx of people, right, coming in, as well as, a growing population and really tax friendly. So, I think that you're going to see different places do well and different places do not so well. And even in those places doing not so well, even in different segments. I mean, I think you're going to have even tougher affordability issues in those other states, like I mentioned, California and New Jersey and New York, whereas, some of the, the good states have been doing well, like Dallas and Texas and, some of these states with low taxes, they're going to probably perform better. And it's just amazing. It really speaks to taxes in general, right? No one wants to talk about, you got to raise taxes. Go ahead and raise them. And you're hearing about some people in New York City, starting to get just chased out because you can go anywhere, right? I mean, if you're in a business where, especially the way you can connect now mobilely, I mean, it's pretty easy to go live 6 months in a day in Florida, come up to New York when you have to, right?
Yeah.
So,
you wonder if anyone will work in an office in the future. You wonder if anyone will work in an office in the future.
Yeah.
We have a lot of remote service.
So that's still my take.
What about
I think it's all over the place. I don't think it. But here's the other thing I would say, and I think people on the call can probably attest to this. Whenever they hear it's the end, It's never that way. I mean, it's always drama on TV. Whenever they say, "Oh my God, it's going to be the end of the world," it's never that bad. You know, and I don't think it's going to be the case here either. In fact, I think you're going to see it'll be. I think the pickup in just buyer perception and confidence will outweigh anything that, you know, some of the tax, you know, headwinds may be.
So if we talk about, you know, the optimism of the economy, we talk about pressure on interest rates, but we talk about the optimism in home buying, although we're probably going to continue to see a decline in rate and term refinancing. I think we could see an increase in cash out refinancing in markets like ours and other places because of the tax reform. But tell us a little bit in terms of how does all this relate to your original prediction of the 2020 under 5? Give us a overview of everything we've talked about in the first part of the hour and how that's does that impact? Are you still sticking with that, or are you making any modifications to that prognostication, or where's Bill Bodner's head at regarding interest rates for 2020?
I do have to make one modification. You know, in the glide path that we were on, right? When we spoke about this, you have to remind me, when did we share that?
2011.
Wow.
I remember even going off the air with you and going, "Hey, do you realize you just said that till 2020? Are you sure you want to say that on the radio? You can't take it back what you say on the radio." You're like, "No, I'm sure of it. I'm sure of it."
Yeah.
And you've been pretty good.
Yeah,
it's held up.
It might be, that might be pretty good. So I'm not waving from that. The one you know, thing that no one ever saw, like the black swan, so to speak, is President Trump coming into office and doing what's happening now in the economy. The one thing that can change that whole forecast is this unprecedented growth. I mean, what's really remarkable, Joe, when you look at this, is that the market has gone up so much, yet mortgage rates have not. I mean, typically it goes to that, you know, that whole, you know, misperception that stocks go up, bonds have to go down. I mean, if that were the case, yields would already be 6 and 7% because the stock market has just been on a rocket, right? So clearly, there's two markets kind of making an argument. Does it belong to be? Should we be that euphoric? Are stocks overcooking it, or are bonds underperforming? Like, should the sell-off be more? And it remains to be seen. I'm sticking with it. But if inflation kicks in and because of this stuff, I mean, we'll probably have to pass. But it's going to be close, even with it. I mean, here we are, 2018. You know, under 5% handle on a mortgage, I think is reasonable, especially as lenders start to say, "Hey, wait a minute, we got to eat some because we need some business." I'll stick with it.
Yeah, well,
you're not missing it by much. Let's put it that way.
No,
it won't be far.
Yeah.
Well, and so speaking about it, you know, domestically, really the only thing that's a threat out there to the economy, which could continue to support interest rates, is the Fed activity, whether the Fed tries to raise interest rates or not. Inflation,
I really think that, and I do. And here's the thing, you know, the Fed. That's another thing. Like, you know, you watch Steve Mnuchin, you know, Treasury Secretary, just this morning and yesterday, talking about the weak dollar is good for us. So he was really jawboning the dollar low, which, by the way, it's why people want to know why the price of oil is going up. It isn't just that all of a sudden we woke up and we're just using more oil or it just disappeared. You know, a good portion of that move in the oil is because dollars are used to price oil. So as the dollar starts to drop in value, the price of oil goes up. Period. There's a dynamic there, and so I think listeners should know that it isn't just all of a sudden. Oh my God, is there a little bit more demand? Yeah, but it isn't like we woke up and a million more cars are on the road. It has to do a lot with what's going on in the forex market and the dollar.
Oh no, and that is not something I've heard out here before. And obviously, price of oil is important in North Dakota, and I haven't heard that. I haven't heard anybody talk about that. So there you go, folks.
Listen, it's a dollar. If I were to bet where the oil goes, if the dollar continues to slide, and it looks like it's sliding. I mean, we're at multi-year lows here. I think that the oil goes higher. Mm-hmm. Okay. And this is dynamic. I mean, the oil is priced in dollars. So as a barrel of if the dollar slides, the price of oil has to adjust accordingly. And so same thing the other way, right? If you remember when oil was so high. As the price of barrel, that's when the dollar was getting clobbered. Mm-hmm. And look at the dollar; it's getting beaten up right now.
So, and that's good or bad for interest rates? That's good or bad for interest rates? Oil going up.
If oil, it could be bad if it's persistent and it gets really out of hand. right? Because what could happen is you could start to see some significant inflation, and then what has to happen is, as a corporation, right? Because oil really gets everywhere. The corporation has to decide, I have one of two choices. Can I pass some of this on as inflation to the consumer, which may not be great, or do I eat it, which may even be worse, right? And it starts to hit earnings. And now, all of a sudden, stocks can have a bad time. So, and in that scenario, the bond market actually kind of stays steady. And that's why, when you look at rates, do you see rates shooting up? No, because there are so many things that jump in that can actually change it. I mean, stocks, don't have to do much. If they just lie flat, I don't see any reason why rates have to go significantly higher, over the near and even intermediate term. But high oil is something that we have to watch. I mean, I'm looking at it now, $65 a barrel. Perfect example of what we were talking about earlier. It's funny how when everybody gets on one side of the equation, you can almost bet your ranch the other way. And I put some of my own money where my mouth was. I remember when oil was like that $30 a barrel. I think it hit like $20-something. And I'm just looking at the headlines, and it couldn't have possibly been any more negative. It will never touch 40 oil. It's going lower. It's probably going to hit 20. And I said, baloney. And I went out and bought Exxon. And I think Exxon at the time was like $66. I mean, you look where it is today. It's like $90, and it hit 100 already really quickly. But, I mean, those are the things. When everybody's betting on something going one way, you can almost bet your ranch it's going to go the other way. And so, and the thing is with the stock market, that's why I think stocks going higher. It still is not euphoric. There's still some pessimism out there. There's still money not coming into the market. We haven't gotten 401k money. We haven't gotten people with more, money that is, disposable from the tax cuts. So I think, that's going to be a tailwind for stocks too.
Yeah, I just read something this morning that they're thinking a lot of the U.S. pension funds are going to move money out of the stock market into the bond market.
Because the Fed's going to create room.
And that goes to the point. That can bring up, David, a whole different discussion as to what you see with, the buying. We worried about China. I know you mentioned not buying, and there's going to be demand. Listen, we're still, while we're a mess, with our debt, we're the cleanest shirt in the dirty laundry, right? So, I mean, it is going to be demand for our debt.
I love it when we're talking about. I love it when we're talking about debt. Our trading analogy is going through your dirty laundry, finding out which shirt smells the least bad. That's awesome. Hey, we're going into the next segment here as we close up. Bill, I'd love to come back and talk about. We've talked about how oil could be a threat to interest rates, but it might be the friend. We talked about the Fed, but I'd like to know what are the global indicators on interest rates, and what are the threats out there globally to interest rates as we look to the future. Back in the next segments, two dumb guys interviewing a smart guy, Bill Bodner, on the Dakota Housing Network. After the break.
Right now, 28.
Dave Ramsey is heard here. SuperTalk 1270.
All right, coming back on Sweet Home Alabama. Can't it get any better than that from Leonard Skinner? Doing a farewell tour over the next year, I guess. So we'll see how that goes, if they actually are farewelling or not. So we're back on the Dakota Housing Network. Dave Flohr along with Joe Sheehan and Jim Walsh on the board, and the Oracle of Dakota Housing Network on the phone, Bill Bodner. It's the segment of two dumb guys asking the smart guy questions, and boy, we got a good one today.
And I'm getting text and messages right now about the cleanest shirt in the dirty laundry right now, Bill. It's funny. Everybody's like, I love that one.
So, Bill, Joe asked you for the last segment to come out, talk a little bit about how is the global stuff going to affect? We got Brexit out there, Japan, China, oil in Saudi Arabia and all that good stuff. How does that play into all this stuff going on here? It's
a great segue and a great way, I guess, for us to end, because when I look at interest rates, you have to look at the globe, because something that I think for the listeners and everybody to consider is that the world, the investors now, especially through technology, it's so easy to trade. They're in search for yield. So you have to watch what the dollar's doing when you transfer in currency. And you're looking to get the yield, and then you want to go with the fastest horse, so to speak. And so when I look at some of the yields first, before I get into some of the things that we're watching, we like to look at the German Bund as a benchmark within Europe, and that has spiked. Can you believe spiked to 60 basis points? Can you imagine? Our 10-year note is 264, call it. Yeah. They're only providing 60 basis points for 10-year paper. but that's up significantly because it was actually about minus 20, in the not too distant past. So it is a big move in yield to go from negative interest rates up to 60 basis points. And so there's a natural spread between our bond market and the Treasury market and the Bund. So if the Bund continues to move higher, it makes it very difficult to near impossible for the U.S. Treasuries to go lower in yield. So when you start thinking about headwinds, you have to look across. And so if inflation starts to happen in Europe, if there's a pickup, and that's something that we watch, the ECB made their announcement this morning. They're going to stay with soft interest rates. There was speculation that they were going to maybe raise interest rates and maybe take away the punch bowl. But here's why, and it's very interesting. Because the dollar has gotten so weak and the euro has strengthened, it puts the European Central Bank in a tough position to hike rates because that only exacerbates their problem. They don't want a strong dollar. Nobody wants to say it, but they don't want their currency any stronger. Why? Because it hurts their exports. So they literally had to back away from maybe taking away the punch bowl to kind of soft-talking the market, saying, hey, you know what? Inflation's not there. It's probably going to pick up. But for now, we're not doing anything with QE. We're going to hold it at least until September. So they pretty much punted. And it was really the markets were looking, saying, if you looked at a month ago, I think it was pretty far-gone conclusion that they were going to say, hey, you know what? We're wrapping this up. QE, we're done. But they had to kind of let the euro kind of hopefully slide a little bit lower because the dollar has been getting clobbered and is becoming in a much more competitive space. So you're seeing, one of the dynamics that's really interesting right now is the whole, globalization and some of this, nationalism, right? Trump is, all about, America first. And, that could create a ripple in the markets because, for the sake of a better term, trade wars, but they've always been there, right? I think it'll be interesting how we come, that this is an area where you have a lot of capital, real capital and political capital at risk. So when those things start to happen, you can see actually the U.S. bond market improve because people, when things get uncertain, obviously money goes into our bond market. That could be a tailwind, which keeps rates relatively low. But the other thing that we look at is that the whole global growth story is starting to improve. It isn't just America; it's everywhere. And this thing with the dollar being low, that really makes emerging countries, economies perform a lot better because they can buy our stuff cheaper, right? It's really amazing. And so if that, in that scenario, you can actually see emerging countries start to improve, their rates go up, our rates tick up with it. And so it really starts to the point where if all the tides are rising, if inflation's rising everywhere, if the economy's starting to grow, it is putting an upward bias towards interest rates. Now, Dave, I think you mentioned some of the things that we have to watch out for. Europe is still a mess as far as a structure. We talked about this a long time ago, and they will have their day of reckoning. You can't have this, these northern capitalistic countries still supporting, folks that take a month off in Italy and Greece. I mean, it just doesn't work. They need one body, and they're starting to talk about it again, right? And I think the way Brexit falls, I think you'll see others. I mean, how they negotiate their way out of Brexit. Remember that gave interest rates a nice relief, right? There was a lot of uncertainty, and money flew into the bond market. Rates, shot lower. That could happen again if that thing starts to, goes through fits and starts. And then once they do figure it out, what does it mean for other countries? Because I'm sure there are other countries like Greece that are ready to raise their hand saying, you know what, I don't want to be here either. So those are some of the things that I look at. And, of course, Japan, we've always talked about aging demographic. It's just, they're ancient over there. I mean, last I checked, it was in the mid-60s. I mean, crazy. I mean, it's so, they have just a structural problem. And so they're going to have to do something really different to grow their economy. But there's so many things out there that could make things, uncertain and help rates. I mean, of course, North Korea and any kind of, things we have going on with China, just with trade, could be disruptive.
What's interesting is we sit here and listen to you go down the global indicators that could impact interest rates. And these were big indicators at one time because they created global uncertainty, which fed the bond markets because they were safety. But you haven't mentioned once North Korea. You haven't mentioned once terrorism. You haven't mentioned once Syria. You haven't mentioned once. And it's interesting to me because if I turn on the TV, this is what I hear about. What I hear about is I hear about ISIS. I hear about terrorism. I hear about North Korea. I hear about the political chatter in the positioning in terms of countries, which in the past was creating a ton of uncertainty that was that was driving safety, the investment, the flight to safety in the bond market, and concern over oil prices, especially in the the beginning part of the decade. And you didn't mention any of that. Why?
I think that the sad reality is I think that the market has grown, immune to some, especially the terrorism stuff, right? I mean, I think that people know. It seems on the surface that the ISIS thing has become a little bit more contained. I mean, obviously we have so much work to do there. It's not a good situation, but I think the market has gotten complacent towards it, and you know what? And that really does speak, as you say, that it does speak that there could be one of those shocks, and those are the things that unknown. But it's not something that you can sit around and worry about. Certainly can't bet on it. I think when you look where what I tell people about rates, be careful what you wish for, because in order for rates, when you're looking at the story, just as how it's playing out now with the economy and optimism, just how people feel, so much more optimistic, that you don't want to bet on a negative shock to get rates to go lower. I think rates are going to be great. They're not going to shoot up unless we get some crazy inflation, which is not in the cards, right? Not something we're forecasting. I think it's just an unbelievable environment. It's almost like the porridge is just right? It's perfect.
Well, here's what I wish for, Bill. What I need, Bill, is I do need interest rates to tick up. I do need interest rates to tick up because in my career, I'm at that age where I need one more big refinance boom to send me into my retirement.
Yeah.
Well, you never know.
It could happen. We have these things. What I watch. We watch the technicals a bit, and what I'm looking at. I mean, just in the last week, the yield on the 10-year note. Now, I mentioned about the yield. Obviously, that is not what prices your mortgages, but it's a good benchmark, and it's something that everybody on this call can listen to. And I think that, the 10-year note just moved above 262, and that was really, in my opinion, like a line in the sand. It's like the highest closing yield since, September of 2014. And just the other day, we're bouncing back and forth, but we can't get beneath it. So it's starting to be like a ceiling, right, or a floor. So, the yield broke above it. It jumped onto the roof, and now the roof is stopping it from getting back into the room beneath it that it broke through. And so I'm concerned that the early signals I'm seeing are that, the rates have moved potentially right now to another level, and we're probably on a step. We're going to move another level higher and probably see 2.75 to 3% on a 10-year note, probably not too distant future.
Which means, oh my God, means 4.5% interest rates. And so which cracks me up is because the first refi boom in 2009 started with 5.25% interest rates and 4.875 rates. So I remember literally having, because we weren't quite paperless back in that generation, we had files all over our office floor because the calls to lock were coming in so fast at 4.875 because rates ticked below 5% in 2009. And so we might just be getting back into that, which was at that time, it was like, it's like the Cabbage Patch Kid of interest rates. I mean, it was like almost the Cabbage Patch Kid of interest rates booming, or the Tickle Me Elmo.
Tickle Me Elmo.
So anyway, but anyway, we're rolling in the last couple minutes. Dave?
Nothing. I just thank Bill for coming on again, and I think we really need to get you on a little more often, Bill.
I love it.
A couple times a year, quarterly or something like that.
I'm not coming up there now; it's too cold. But there's every time in the
well, we'll get you on the
swing
radio.
by and hang out with you in the shop. That'd be great.
Bring your drums up. We'll do some covers.
Yeah.
But we get you on.
I'll bring my golf clubs. I'm a
radio.
golfer too. I'll bring my sticks. That's what we'll do. You probably have some really nice golf
courses.
Oh, the
Bully Pulpit out in the Badlands.
Bully
You'd love
Pulpit,
that one.
Hawk Tree. Yeah. Yep. But anyway, we need to get you on the radio more often too.
Well, here's our most recent and one of our best editions of
Two guys asking a smart guy questions.
So, hey, thanks Bill for coming on. We appreciate all the insight into the market here on the Dakota Housing Network.